Okay, so you guys have been sending in some really interesting stuff about REITs,
Yeah.
and specifically focusing on the dividends they can provide, which can be really juicy for investors.
Yeah. REITs have always been.
But we're going to try to take a deep dive today
Sure.
and look for some of the warning signs that some REITs might be signaling that they might be cutting their dividends in the future.
Right.
So that's our mission today.
Sounds good.
And for a lot of investors, REITs seem like a really great place to go.
Absolutely.
Especially for that income stream.
Yeah, if you're looking for consistent income, REITs are definitely an attractive area.
Yeah, and there's a reason for that, right?
Yeah, and one of the key reasons is how they're structured.
Right.
From an IRS standpoint, REITs have this special designation where they get these tax advantages. But to keep those advantages, they have to pay out at least 90% of their taxable income to shareholders in the form of dividends.
Right. So that's why it's so important to look at the health of those dividends, because that's a direct reflection on the health of the company itself.
Yeah, it really is a critical barometer for the overall financial stability of the REIT.
Yeah, so we're not just talking about REITs in general today.
Right.
The stuff that you guys have sent in has pointed us toward 3 specific REITs that have been raising some red flags.
Yeah, some potential trouble spots.
Yeah. And the first one that we want to jump into is Medical Properties Trust.
All right, MPW.
MPW, yeah, the ticker symbol.
Yeah.
And this one is a big player in the healthcare space, right?
Yeah, they're a major healthcare REIT.
Yeah.
They own a huge portfolio of hospitals and acute care facilities. And, for a while, this was seen as kind of a classic high-yield, safe investment.
Yeah, supposedly recession-proof.
Exactly.
Right.
Yeah, healthcare, People always need healthcare.
People always need healthcare.
That's the thinking.
But the source that we were looking at is painting a little bit of a different picture.
Yeah, a little bit more of a cautionary tale.
Yeah, so let's dive into the concerns that they raised.
Okay, sure.
And the first one was tenant concentration.
Yeah, that's a big one.
Meaning that they're really reliant on a small number of tenants.
Right. And when you have so much riding on just a few tenants,
right,
that really magnifies your risk.
Okay, so like if one of those tenants goes down, then suddenly you've got a big problem.
You're in trouble.
And the big tenant that they were pointing to as a potential problem is Steward Healthcare.
Yeah, Steward's a major tenant for MPW.
Yeah.
And there's been a lot of chatter about their financial health.
Yeah, and the concern is that if Steward is having problems paying rent,
right,
that's going to flow directly downhill to MPW.
And that's where the real risk for MPW investors comes in.
Yeah.
Because if they're not collecting that rent from Steward,
right,
they're not going to have the money to pay those dividends.
Right. Right. And the source was saying that MPW has already restructured some leases.
Yeah, that's a red flag for sure.
And deferred some rent payments.
Yeah, and when you see that happening,
it
often means that the tenant wasn't making those payments in the first place.
Right. It makes you wonder what's really going on behind the scenes.
Yeah, exactly.
So that's a big concern right there with that tenant.
Absolutely.
Another concern was their debt load.
Yeah, debt's always something to watch closely with REITs.
Right.
Especially in this environment.
Yeah, because they are carrying over $10 billion in debt.
Yeah, that's a big number.
Yeah. And interest rates have been rising.
Exactly.
So what's the problem with that?
Well, it makes refinancing that debt a lot more expensive.
Right.
And when you've got that much debt hanging over your head, it really limits your options.
Yeah, you don't have a lot of flexibility.
Not at all.
To make moves.
Yep.
And then another thing that the source mentioned was shareholder dilution.
Ah, yes, the Oprah effect.
Oh, Oprah effect.
Yeah, you get dilution. You get dilution, everybody gets dilution.
So what exactly does that mean?
So basically, they've been issuing more shares.
Okay.
Which means that each existing share represents a smaller piece of the pie.
Right.
So you're getting diluted.
So your slice is getting smaller.
Exactly.
And that's not a good thing for investors.
No, really.
Because it can really put downward pressure on the share price.
Yeah, and it can also make it harder to grow the dividend in the future.
Right.
Because now you've got more shares to spread that income across.
Right. So all these things together are painting a pretty worrying picture.
Yeah, it's not looking great for MPW.
So what did the source say about the dividend?
Well, they pointed out that MPW already cut its dividend by 50% this year.
Wow, 50%.
Yeah, pretty big cut.
So is there a chance they might cut it again?
The source seemed to think that further cuts are definitely on the table.
Oh, wow.
Yeah, given all the challenges they're facing.
Okay, so what was the final verdict on MPW?
They said sell now.
Just get out?
Yeah, they basically said if you're holding on to MPW, you're setting yourself up for disappointment.
Okay, so they're not mincing words.
Nope, they're pretty clear about the risks.
All right, so that's MPW.
Yeah.
Potentially some trouble brewing there in the healthcare space.
Right.
Let's move on to a REIT that focuses on commercial properties.
Okay.
And this one is Global Net Lease. The ticker is GNL.
All right, GNL.
GNL. And, this one sounds a little bit safer at first glance, right?
Yeah, on the surface, it seems like it could be a pretty stable play.
Yeah, they own a bunch of properties all over the U.S. and Europe. And they do these long-term net leases.
Yeah, which is typically a pretty boring type of REIT.
Right. Low risk.
Yeah, steady Eddie kind of stuff.
Yeah, but this source is saying that this one's actually anything but boring.
Yeah, they're calling it high yield, high drama.
High yield, high drama.
And a balance sheet from hell.
Wow. That's a pretty vivid description.
Yeah, they definitely didn't hold back.
So what's causing all this drama?
Well, the first red flag they pointed to was the dividend yield.
Yeah.
Which is currently around 12%.
That's really high.
Yeah. And whenever you see yield that high,
yeah,
you got to ask yourself, what's the market trying to tell me?
Right. What am I missing here?
Exactly. Because usually those sky-high yields are a sign of trouble.
Right. Because the market is basically saying that they don't think that dividend is going to last.
Yeah. They're pricing in a potential cut.
So is the market right to be worried?
Well, the source says yes. They point to GNL's AFO coverage.
AFFO.
Yeah. Adjusted funds from operations.
Okay. And what is that exactly?
It's basically the real cash flow that a REIT has available to pay its dividends.
Got it.
So it's a key metric to watch.
Yeah.
And in GNL's case, their AFO coverage is really weak.
Meaning
that they're barely scraping by.
Oh.
Yeah, their AFFO is barely enough to cover their current dividend payments.
So there's no room for error.
Exactly. If anything goes wrong with their tenants,
yeah,
they're going to have to cut that dividend.
Okay, so that's a problem.
Definitely.
The source also mentioned a recent merger.
Yeah, they merged with the Necessity Retail REIT last year.
Okay.
Ticker symbol RTL.
RTL. And how did that go?
Not well, according to the source.
Okay.
They called it a disaster.
A disaster.
So it's like two broken legs trying to hold each other up.
Oh, wow.
And that it's created a real circus.
So not the synergies that they were hoping for?
Nope.
And then like MPW, it seems like debt is a big issue here too.
Yeah, debt's rearing its ugly head again.
So how bad is it?
Pretty bad. Their debt is ballooning.
Okay.
And over $2.2 billion of it is in floating rate debt.
Which is a problem because...
Because when interest rates go up,
yeah,
so do their interest payments.
Right.
They're basically a deer in the headlights every time the Fed sneezes.
Oh, wow. So they're really exposed to those rate hikes.
Yeah, they're very vulnerable.
Okay, so they're paying out 40 cents a share every quarter right now.
Right.
But it doesn't sound like that's sustainable.
The source doesn't think so.
So what do they think's going to happen?
They think a dividend cut is practically inevitable.
Okay, so this is another one to watch out for.
Yeah, they called it a yield trap, wrapped in a value trap.
Oh, wow.
And they said sell before your dividend dreams implode.
Okay, so not a very optimistic outlook.
Nope.
All right, so we've talked about MPW in the healthcare sector.
Right.
And GNL in the commercial property sector. Now let's move on to our third REIT, which is Office Properties Income Trust.
OPI.
OPI, ticker symbol OPI.
Yep.
And this one's interesting because it's all about office space.
Right.
And the source is saying that this is like investing in VHS tapes.
Yeah. In the age of Netflix.
In the age of Netflix, right?
Extracted.
Like, who's using VHS tapes anymore?
Yeah.
Right. So the concern is that with the rise of remote work, office space just isn't as in demand as it used to be.
That's the big problem facing office REITs right now.
Yeah. And OPI is right in the thick of it.
They are.
So what are some of the specific challenges that they're facing?
Well, the biggest one is low occupancy rates.
Right.
A lot of their buildings are sitting empty.
And that's a problem because
if nobody's renting the space, you're not making any money.
Right.
And that directly impacts their net operating income, or NOI.
Yeah, so their income is going down.
Exactly.
And what about their debt?
Oh, yeah, they've got a lot of debt, too.
How much?
Over $2 billion.
And that's coming due soon, right?
Yeah, they've got a big maturity wall coming up.
So what are they going to do?
Well, they've said that they might have to sell off some assets.
To raise cash.
Yeah, to pay down that debt.
But isn't that kind of a fire sale, though?
It could be.
Because if they're forced to sell, they're probably not going to get the best prices.
Exactly.
Now, the source also pointed out that a lot of OPI's tenants are government entities.
Yeah.
Which you might think would be a good thing.
You'd think so.
Because the government's always going to pay their rent, right?
Well, that's the hope.
But what's the problem then?
The problem is that even the government is starting to downsize.
Oh, really?
Yeah, they're embracing remote work, too.
I see.
So there's a chance that even those government leases might not get renewed.
Or they might get renewed at a lower rate.
Exactly.
Oh, wow. So that's not good.
Not for OPI.
And what about the dividend?
They already cut it pretty drastically earlier this year.
How much?
It went from 55 cents a share down to 25 cents.
Wow. That's a huge cut.
Yeah, it is.
So is there a chance they might cut it again?
The source seemed to think that further cuts are a real possibility.
Okay, so what was the final verdict on OPI?
They said, sell and don't look back.
Wow.
Yeah, they were pretty harsh.
They think it's that bad.
He said it's circling the drain.
Oh, wow. Okay, so we've looked at 3 REITs.
We have.
MPW, GNL, and OPI.
Yep.
And it seems like there are some common threads running through all of them.
There are some definite red flags.
Yeah, so what are those red flags?
Well, the source gave us a really helpful checklist.
Okay, let's hear it.
The first thing they all have in common is over-leveraged balance sheets.
Meaning?
Meaning they have way too much debt.
Okay.
And not enough cash flow to support it.
Got it.
The second red flag is unsustainable dividends.
Okay.
They're all paying out more in dividends than they're actually bringing in.
So they're kind of faking it till they make it?
Exactly.
Okay.
What else? Tenant risk is another big one.
Right.
Whether it's too few tenants like with MPW.
Yeah.
Or financially shaky tenants like with GNL.
Right.
Or uncertainty about future occupancy like with OPI.
Yeah. So they're all really vulnerable to problems with their tenants?
They are.
And the final red flag?
Poor management decisions.
Okay, so what kind of decisions are we talking about?
Things like share dilution.
Right.
Overpaying for acquisitions.
Okay.
And bad mergers.
Like that GNL merger we talked about.
Exactly.
So these are all signs that management might not be making the best choices.
Right.
And the source used a really interesting analogy. To describe these REITs, they said they're like a leaking boat. Yeah. So even if they've performed well in the past, their fundamentals are deteriorating, and eventually that boat's going to sink.
It is.
So it's a good warning to heed.
Definitely.
But the source didn't just leave us with all this doom and gloom.
No, they gave us some hope.
Yeah, they actually suggested some alternative REITs.
They did.
Some quality REITs that they think are in much better shape.
Right.
So who are these potential winners?
Okay, the first one they mentioned is Realty Income.
Realty Income.
Ticker symbol O.
Oh.
And they're known for their consistent monthly dividend payments.
That's nice.
Yeah, it's a nice steady stream of income.
Yeah.
They also have a very diversified portfolio of tenants, which reduces their risk.
Makes sense.
And they've got a really impressive track record.
Okay, what kind of track record?
They've increased their dividend for over 100 consecutive quarters.
Wow. That's amazing.
Yeah, it is.
So this is a really solid company.
Yeah. The source described them as boring in the best way.
Yeah, I can see that.
They're just reliable and steady.
Okay, so what's the second alternative?
The second one is Prologis.
Prologis.
Ticker symbol PLD.
PLD.
And they focus on logistics REITs.
Okay.
Which means they own warehouses and distribution centers.
So they're benefiting from the growth of e-commerce.
Exactly. They're in a really good position right now.
Yeah, I mean, everybody's buying stuff online.
That's right.
So those warehouses are in high demand.
They are.
And what was the third REIT that they mentioned?
The third one is Agree Realty.
Agree Realty.
Ticker symbol ADC.
ADC.
And they're a retail REIT.
Okay.
But they focus on recession-resistant tenants.
Like who?
Companies like Walmart, Tractor Supply, Dollar General.
Okay, so even if the economy slows down, people are still going to need to buy groceries and stuff.
Exactly.
So these tenants are more likely to keep paying their rent.
That's the idea.
And the source also mentioned that Agree Realty has a really clean balance sheet.
Yeah, they're in a very strong financial position.
Okay, and their dividend.
It's growing.
So that's good.
Yep.
Okay, so we've got some potential bright spots here.
We do.
But I think the overall message of this deep dive is that we need to be proactive.
Absolutely.
About managing our REIT portfolios.
Especially when it comes to those dividends.
Yeah, because if a company cuts its dividend, it's not just about losing that income stream.
Nope.
It's also about the hit that your portfolio takes.
Yeah, the stock price usually tanks.
Right.
And it can be really hard to recover from that.
So the source ended with a really thought-provoking question.
Yeah, it was a good one.
Do I want to beat the crowd to the exit?
Or get trampled in the stampede after the next earnings report?
Yeah. So basically, are you going to be proactive or are you going to wait until it's too late?
Exactly.
And I think that's a great question for all of us to ask ourselves. So we really hope that this deep dive has been helpful.
Yeah.
And that it's given you some things to think about.
I hope so.
And if you are holding any of those 3 REITs that we talked about, MTWGNL or OPI, you might want to take a close look at them.
Definitely.
And consider whether it might be time to move on.
That's right.
And, the source said something that really stuck with me.
What was that?
They said that there's nothing more painful for an investor than watching both their income and their capital disappear.
It's true.
While clinging to a sinking ship.
Yeah. It's a tough lesson to learn.
Yeah. So hopefully we can avoid that pain.
Hopefully.
By being proactive and making smart choices.
Absolutely.
And if you want to refresh your memory on all the details about those 3 REITs, the source actually included a really handy TLDR table.
Oh, that's helpful.
Yeah, it's got all the key information about the dividends, the problems, and the verdicts.
Cool.
So yeah, we encourage you to check that out.
Definitely.
And thanks for joining us for this deep dive.
Yeah, thanks for listening, everybody.
And we hope that this information will help you make informed decisions about your investments.
We'll see you next time.
See you later.
Bye.
Bye.